The return of the gold question. In 1971, US President Richard Nixon closed what was known as the gold window. From that moment, the dollar was no longer convertible into gold at a fixed price, and the world officially entered the era of fiat currencies, money backed not by metal, but by trust in governments and institutions. For decades, this system defined global finance. But today, the question is returning. Could gold once again play a central role in money? The renewed discussion is not about nostalgia. It reflects deeper uncertainty about how stable our current financial structures really are. Why the topic matters again. The interest in gold's monetary role has not appeared randomly. It has been driven by waves of inflation, aggressive monetary policies like quantitative easing, and growing geopolitical tensions. When economies become unstable and confidence in currencies weakens, people naturally begin searching for alternatives. Gold re-enters the conversation because it exists outside political control. It cannot be printed, diluted, or digitally created. That independence makes it both attractive and controversial. As uncertainty rises, the idea of gold as a monetary anchor starts to feel less theoretical and more practical. Aim of the discussion. This presentation does not try to glorify gold or criticize modern finance. Instead, it aims to understand the real picture. What role could gold realistically play today? What do historical data, expert opinions, and financial trends tell us? We will avoid myths and emotional narratives and instead focus on facts, numbers, and scenarios. Because the key question is not whether gold belongs to the past, but whether it still has a place in the future. Understanding that requires context, history, and a clear look at how the financial system actually works. Keynes. Gold as a barbarous relic. One of the most famous criticisms of gold came from economist John Maynard Keynes, who called the gold standard a barbarous relic. His argument was simple but powerful. Tying money strictly to gold made economies rigid. Governments had less flexibility to respond to crises, and deflation could become severe. In Keynes's view, modern economies needed adaptable monetary tools, the ability to adjust interest rates, manage liquidity, and stabilize growth. To him, gold represented stability, but also limitation. Greenspan, gold and freedom. On the opposite side stood Alan Greenspan, long before he became chairman of the Federal Reserve. In his early writings, he argued that gold was deeply connected to economic freedom. According to this perspective, gold limits political power because it cannot be created at will. Governments cannot inflate it and therefore cannot easily erode purchasing power. Supporters of gold see it as a safeguard, a protection against irresponsible policy and currency devaluation. In this view, gold is not restrictive, it is protective. De Gaulle's position? Between these two extremes stood Charles de Gaulle, the French president who challenged the global monetary system in the 1960s. He believed gold should remain the ultimate anchor of value. France even began exchanging US dollars for physical gold and transporting it back to Europe. This was not only an economic move, it was geopolitical. It reflected concerns about dependence on another country's currency. These three perspectives, Keynes, Greenspan, and de Gaulle, still define today's debate. Is gold a relic, a safeguard, or a strategic tool? The answer depends on how we view power, stability, and trust in the monetary system. Models of a gold return. When people ask whether gold could return as the foundation of money, the first important point is this. There is no single model. A return to gold could take many forms. One possibility is the classical gold standard, where banknotes are directly convertible into a fixed amount of gold. Another is the gold exchange system, similar to Bretton Woods, where one currency is linked to gold and others are tied to that currency. There are also modern ideas such as using gold as a policy reference, a benchmark to guide inflation targets without full convertibility. And some economists propose a commodity basket where gold is combined with other resources to stabilize purchasing power. Each model represents a different level of commitment and control. Alternative structures. Beyond traditional models, there are more radical possibilities. One is free banking with gold backing, where private institutions issue currency linked to gold instead of relying on central banks. Another idea is a more market-driven system, where gold acts as a competing form of money alongside national currencies. In such scenarios, central banks would have less control, and financial systems would rely more on trust, discipline, and competition. These approaches challenge the modern structure of money, but also raise questions about stability, regulation, and risk. Implications of each model. Every model of returning to gold comes with consequences. Economically, it could reduce inflation risks but limit policy flexibility. Politically, it could shift power away from governments and toward markets or physical reserves. Operationally, it would require new systems, audits, and coordination. And financially, the transition could be expensive and complex. That is why discussions about gold are rarely simple. They are not only about metal, they are about how societies organize money, power, and trust, gold coverage, and money supply. One of the most revealing questions is this: what would it take for gold to fully back modern money? The United States holds about 8,133.5 tons of gold. That sounds like a huge amount, and it is. But when compared with today's money supply, it becomes clear how different the modern system is. To support all circulating money, gold would need to be valued at dramatically higher prices. This highlights the scale of change between past monetary systems and today's financial reality. Estimated gold values. If gold were used to back the full US money supply, estimates suggest prices would need to reach around $84,000 per ounce. Backing only the monetary base would require roughly $22,000 per ounce, and covering only physical cash in circulation would imply around $9,000 per ounce. These numbers are not predictions, they are illustrations. They show how far current financial systems have expanded relative to physical gold reserves. Money has grown faster than the metal that once anchored it. Meaning of these numbers? What do these figures really tell us? They reveal the difficulty of returning to a fully gold-backed system. The transition would not be simple. It would require adjustments in prices, policies, and expectations. But they also highlight gold's monetary significance. Even today, gold remains a reference point for value. It exposes the imbalance between physical resources and financial expansion, and it reminds us that money is not only numbers, it is a structure built on trust, scarcity, and credibility. Global gold supply. To understand the monetary role of gold, we must first understand its physical reality. The total amount of gold ever mined in human history is estimated at roughly 212 to 216,000 tons. That may sound enormous, but when compared to global wealth and financial assets, it is surprisingly small. Each year, mining adds only about 3,000 tons. This slow growth means the supply of gold increases gradually and predictably, unlike paper money, which can be expanded rapidly. This natural limitation is one of the reasons gold has historically served as a monetary anchor. Gold as hard money. Gold has characteristics that make it unique among financial assets. It is rare, durable, and portable. It cannot be easily destroyed, and it does not depend on any government or institution for its existence. For centuries, these qualities made it ideal as hard money, a form of value that cannot be inflated or manipulated easily. People trusted gold because it existed outside political systems. It did not promise value, it was value. That distinction shaped its role in global trade and finance for generations. Supply versus money supply. Now compare that limited gold supply to modern money creation. Global financial systems have expanded dramatically, with digital money, credit, and derivatives growing far faster than physical resources. This imbalance explains why gold retains monetary importance. Its scarcity reinforces its value. It reminds markets that real assets have limits, and it provides a counterweight to financial expansion. Gold's role is not about replacing money, it is about anchoring it, reminding economies that value cannot grow infinitely without consequences.